All right, I'm Chris Campbell. I'm a practicing CPA, and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about the home sale tax surprise. I encountered a client that recently experienced this, so I figured I'd explain it just to make people aware of what's going on. If you sell your primary residence, you have a gain exclusion of $250,000 if you're single and $500,000 if you're married. And it's pretty common knowledge as far as that exclusion, even if you're dealing with realtors and anyone on the periphery of the real estate industry kind of knows that rule, right? If you're married, you get up to $500K. Excluded, you don't have to pay taxes on a K of gain. The rule of thumb is that you've had to live in the house as your primary for at least 2 years before that kicks in. So most folks know this, and that's great. However, there is an exception, and a lot of people can get blindsided by this exception based upon if you operated a business and you took the home office deduction. If you took the home office deduction as a part of your business and you use this particular home, if you use the actual expenses method, which allows you to depreciate a portion of the home, when you go and sell that home, you have to pay the taxes back on the depreciation that you took. And the technical term for it is depreciation recapture. And the federal tax rate for that is 25%. And you're paying that on the depreciation that you've taken over the course of time. So if you've been in your house for, say, 10 years, and you've been deducting depreciation for 10 years, say $2,000 every year, and you were in there for 10 years, that's $20,000 over the course of 10 years. When you go to sell that house, you would have to pay the recapture tax on that, which is 25% on that $20,000. So there is a tax that you do need to pay, and sometimes that catches folks off guard because they figured as long as they were under that 500K threshold, then the sale was clean and you don't have to pay anything on it. So you need to go ahead and pay it if you were taking depreciation on that home office. And another caveat is that you have to pay it back whether you took the deduction or not. So let's say that you decided not to take depreciation for the reason of, I don't want to pay the taxes back. And you do all the other actual expenses. So you take your utilities, the taxes, the mortgage interest, and you're writing all that stuff off, but you choose not to do the deduction for the depreciation. That does not get you out of paying it. The rule is if you were eligible to take it, you have to pay on it. So you can't say, I didn't take the depreciation deduction to avoid paying taxes on it when I sell. If you were eligible to do it, then you got to pay on it. Now, whether you actually did it or not, if you didn't do it, then that's just on you. And you actually lose that deduction and still have to pay the taxes on it. Make sure you always take that deduction. Just something quick that you need to know and take into consideration when you're selling a home and if you're trying to figure out what your complete liability is. Now, you want to take the home office deduction and you want to avoid that altogether. The best way to do it would be using the square foot method, where I believe it's $5 per square foot. So what you would do is just take your office space, figure out the total square footage, and multiply that by $5. I think that's the most recent rate. I don't remember if it changes every year or not, but the last time I checked, it was about $5 per square foot. So if you do that, then you don't have to worry about the depreciation recapture. The disadvantage of that is you're more than likely going to get a higher deduction if you use the actual expenses versus using the whole square footage method. So the deduction isn't as high. I would probably just take the actual expenses and just plan to pay the taxes on that once you sell, especially if you plan on being in the house for a long time. If it's a shorter term play, maybe that is something to think about, but I always feel as though no need to pass up on current deduction, save you the money now, and then you can work out the tax in the future if it's within reason. I think it's a matter of just properly planning for it. So that's all for now. If you have any questions on this topic or any other tax or accounting related questions, feel free to reach out. Happy to help. All right. That's all for now. I'll talk to you in the next one.